Serge, welcome to the show today.
Thanks for having me. Longtime listener, big fan. Best podcast in the multifamily business.
Nice. All right. I appreciate that. Well,
Garen's been a great addition, by the way.
Well, he certainly has.
Thanks, Serge. I paid him to say that, guys.
We want to know a little bit more about your journey from, W-2 to full-time. And then we want to hear a little bit about about your strategy of converting hotels into multifamily. That's pretty cool. And that's certainly due to most likely what's going on with COVID and maybe even beyond. So I want to definitely get into that. But you have one of many examples of people who have quit their jobs with multifamily. So talk to us a little bit about that. How did you get started? How did it come about?
So I was a corporate warrior from 1999 all the way to 2012. So it's 13 years in the rat race. Knew probably month one that wasn't for me. So it was kind of a search of what's going to be the next thing, what's going to be what gets me out of it. And growing up in the Silicon Valley and seeing, a lot of people jumping into tech and making instant millions, I thought that was going to be it. I thought it was going to be starting a internet company, website, and I actually did that, started a few. But realized that entrepreneurial didn't fit my talents the best. I was good at buying stuff and selling stuff for a little bit more, right? And I was doing that since I was a kid. So I needed something that I could buy and sell consistently, and that replaced my day job, right? And my day job was a corporate controller at a software company. I had moved my way up to that position from public accounting, all the way to the point where by 2009, we purchased a smaller company in Mesa, Arizona, which gave me the opportunity to move out from the Silicon Valley to Arizona. And right around that time, the whole world collapsed with the Great Recession. Saw the writing on the wall, started buying single families, purchased those pretty much at a clip of 5 to 15 a year for the next 5 years until on paper, it seemed that the cash flow replaced my income. And at the exact same time, a larger listed company came and purchased us. And I knew the writing was on the wall for me, being in the admin/accounting group, that we were repetitive. And that was a great exit for me to jump into real estate full time.
Yeah, it's awesome. And so like with so many people, you got to start with single family houses. And how many houses did you have at that point? I'm doing some simple math. It's quite a bit.
Yeah, I got up to about 60 to 70, somewhere in between there. And we were buying and selling the whole time. So it would be, you buy two, one appreciates more than the other. You sell that one and buy another three, refinance two of them and buy another two, sell one and buy another three. So it's kind of that progression. And the whole time the market kept increasing. And the whole while we were building, network, relationship, brokers, the whole nine, to be able to continue the deal flow. And the deal flow continued well into 2016, 2017. But by 2012, we had dabbled in our first multifamily, which was It was a 32 unit in a tertiary market that was beholden to a jail. It was a far out market. I wouldn't say far out. Gary, Florence, Arizona, right? It's got a big penitentiary, and that was the whole industry over there. So we lived and died by the jail and got a good taste of economic impact that industry can have, right? And at the same time, Arizona had SB 1070, where they were checking papers, and my tenants were primarily those tenants at the time. And so the ups and downs of the market, but I learned that if your basis is low enough, nothing matters. Nothing matters if your basis is low enough. Low price per door solves all ills, at least at that time.
So Serge, how do you know that it's low enough price for? Like, what kind of methods do you get into to find these types of things? Because obviously it takes time, but you're kind of a deal junkie, which I love because I am myself. And so we relate a lot on that level, but everybody's got their own strategy, their own technique around sourcing those and like looking and analyzing them. What's kind of yours?
So I used to be, when I first started, it was all about just the cheapest deal, right? So if the cheapest deal on, the MLS, for example, is 100,000, I'm looking for something for 75. And that made me feel good, right? Very, very basic, very unsophisticated, right? And it served me well because, housing was so cheap and rents didn't go down, right? So you're buying at 60, your rents are 1,400. Well, those numbers work, right? And the cheaper you buy it, the higher the rent. It's that easy. Today, and as the market evolved, you realize that price per door kind of has nothing to do with it, right? Because your underwriting completely changes. So I just want to be what I'm looking for today in a price per door is more of a floor. What's my floor if the market tanks on me, right? If I'm left holding the bag and this asset is no longer a favored asset, which multifamily is today, right? Today, if you're over 50, 60 units and you're in most markets, there's a buyer for you, right? And he's probably going to overpay. But I remember the times when that wasn't the case, where you couldn't move multifamily in a tertiary market, where tertiary markets or certain markets, even Phoenix, stopped building altogether, right? So for me, it became kind of the inherent value, the intrinsic value. What does it cost to rebuild this unit, right? What does it cost to rebuild this unit? And the reason that gave me comfort was because I knew one way or another that building would come back, right? I knew that it's not going to be, that cycles don't last forever, a down cycle or an up cycle, and that building's going to come back. So if you can't rebuild this 2-bedroom for less than 120,000, there's some comfort in knowing that you bought it for 75, right? Even if your rents are only 750 today, right? You know that your rents are going to increase. You know that your cost of building is going to increase, right? And so today I'm just looking at price per door as a metric of what are other investors buying price per door? What is my rebuild cost in this market, right? And what's my worst case scenario? But other than that, it doesn't give you much more comfort, right? Knowing that you bought it at 30 a door when everybody else is buying at 50, good for you.
Yeah,
right?
It's so true. We were buying stuff at 32,000 a door in Memphis like several years ago, right? And now we just bought one in northern Atlanta for 200,000 a door. I was like, are we nuts? But like basically it really depends on the underwriting and the numbers, right? It's not the price per door, it's the returns that you get from those investments. And it's so true. Like, Serge, tell us a little bit more about the thing that you're recently doing, which is converting hotels to multifamily. That's really interesting. Well, first of all, is this opportunity been around for a long time, or was it maybe made possible through COVID or accelerated? Talk to us a little bit about the opportunity.
Well, the opportunity has been around for a long time, and I had been preparing for a number of years. It's not something that we just jumped into lightly. The opportunity, let me back up. The opportunity was not around because hotel valuations were so high pre-2000, let's call it 18, 17. So you could buy multifamily cheaper, quality multifamily cheaper than a hotel. Hotel cap rates were 5%, 6%. They were low and you were running a business. So why go through all the hassle when you can passively buy a multifamily, let your property manager come in, do your plan, and make money while you sleep, right? So why would you even look at a hotel? But come around 2018, 19, with the run up in multifamily became so expensive where it got to the point where, I was underwriting and walking these deals and the real estate was junk, right? So I'm sitting here saying, okay, now I got to pay stuff I used to buy for 40 a door that I was renting for 900. Now I got to pay 100 a door and rent it for 1,000, right? So it was really hard for me to get around that. And in 2018, 19, I became less bullish on the market. It felt like it had run its course. And I probably would have sat on the sidelines with multifamily for a while because that was my position, that prices were overinflated. I think COVID, in essence, bailed us out in that regard, multifamily wise. I think we were really getting frothy. And so at that point in time, I started looking at, for fun, really, I had a couple of brokers that were friends of mine, hotel brokers, and said, "Hey, look at this deal." And I said, "I'm not a hotel guy. I'm a multifamily guy. Why would I look at this deal?" Well, no, this one has all kitchens. It would make a great multifamily. And I started looking at it and realized that the hotels were trading still at a fairly low cap, but on its business income, on its NOI. And what sets hotels apart is that there is a lot of really bad operators in the motel space, in the hotel space. There's a lot of really bad operators, and there is a lack of competent property managers, right? So you look at the hotel space, 95% of these guys are self-managing their assets, okay? And probably half or more of those guys are out of state, right? And the majority of those guys have 5 to 10 hotels, right? So they're operating I started underwriting these assets and looking at 100-unit hotels, and it didn't matter the quality, right? It could have been a Marriott or a Hilton, and they're doing on 100 units, they're doing 300,000 NOI. And I'm sitting there saying, a 100-unit apartment complex, I'm doing a lot better than 300 NOI, and they're doing 300 NOI on 2 million top line. So I'm saying, God, there's a lot of inefficiencies here. Could this work for multifamily? So I started researching the zoning and the permitting and what it looked like in different cities. And again, these were a lot of barriers to entry, which I like, right? So pre-COVID, actually, I was able to get the first one in contract, which was very difficult. I had been making offers on probably 5 to 6, maybe more pre-COVID, and not being in the hotel space, I just couldn't get these brokers to take me seriously. There were still a lot of buyers, and they're just like, you're a multifamily guy. What are you going to do with this? Do you have the debt? I couldn't get them around. So they were basically using me to set a floor on the price, like they do with inexperienced multifamily guys, the guy that swoops in from California, owns no assets in your state, and he thinks he's going to get a good deal, right? They're going to use him as a floor for the real buyer. That was happening to me. So there's a lot of frustration. And then finally, I made some inroads with a broker. The perfect asset came up. It was a 70 unit in a market I was already in, had all kitchens. Half of them were true 1-bedrooms, and it was in a market that was very easy permitting wise. And so I went very aggressive on my offer, still almost lost it. They still used me as a floor. And I just went aggro on the broker. I'm all, dude, I know what you're doing. What price do I got to pay? I want this to stick. I want to prove that doing deals with me is easy. And I got that deal. And that deal was in, what was it? It was in February 2019. And it was supposed to February 2020. And it was supposed to close in March. By the end of March 2020. So what happened in March 2020. All of a sudden, Corona breaks out, and Hilton's share price dumps 75%. And I'm sitting here telling the broker, how am I supposed to pay? What makes you think that the value of this 70 unit hasn't gone down when the most storied brand names in America are off 70%? So there's going to be a retrade, and I know, and I'm not a retrader. I pride that when I make a deal, price it sticks. But in this case, I actually took the leap of faith, bought it with a retrade that was about 15% off the purchase price. The owner at that point just wanted out. He was out of state. Purchased it, did the entitlements, brought in a multifamily property manager. Implemented a system, which I had been dabbling with as far as property management software, and kind of doing this hybrid of multifamily. Because when you buy a hotel asset to convert to a multifamily, it's going to take a regular property manager it's going to take them months and months to lease it up. It just doesn't happen quickly. They operate on property manager time. So I found the most efficient way to do that was to operate it as a quote unquote Airbnb, really a short-term rental, and then give the property manager units to slowly lease up. So you keep the revenue flowing, And we had learned how to do this because we had been operating Airbnbs in all of our multifamily since 2012, since Airbnb started, right? So we had been operating, figuring out, what furniture to use, how to remodel for that target class compared to the multifamily segment, what property management software to use, what locks to use, how to do this. And so by the time we did it, we were fully prepared.
So let me get this straight. So you used some of the multifamily you had up to that point. Did you Airbnb all of it, some of it? And why did you do that?
So small percentage. So for example, on a 60 unit, maybe we would do 10. On a 100 plus unit, it would vary. Each multifamily that we owned at the time had a set aside of between 3 to 10 units that were Airbnbs. And it was really just a strategy to maximize income, right? Because what we were looking for was the sweet spot, right? That served all contingencies. Contingency A is to keep it passive and allow the property management team and the payroll that I already had on site to manage the Airbnb. So I didn't want to hire a new manager. I didn't want to rebuild processes. I wanted to just do the listing, control the remodel, and let the property management team on site manage it. So to do that, I couldn't do more than 3 to 10, depending on how good the team was on site. The second consideration was the exit, right? Fannie Mae, and it varies over time, doesn't like short-term rentals, right? And I realized that my exit buyer was more likely than not going to come in with GSA debt. So I wasn't going to overload these properties with 50% Airbnbs where they couldn't figure out how to underwrite it, right? So each property had its own. And basically what I was trying to do was to eat up the loss to lease, eat up the vacancy, and eat up the property management inefficiencies, right? That exist by basically getting this property to operate at its maximum efficiency. And in the process, we were learning how to run a hotel basically, right? With each multifamily that we bought, we'd go through this, all the pains. And so by the time 2020 hit, right, we were uniquely positioned to move on these kind of assets.
What's some of the biggest challenge that you had to undergo when you got into this? You talked about getting the permitting and the zoning. What are some of the things that someone thinking about is, oh, Serge, this is great, I'm going to get into it tomorrow. Like, what are some of the things that people need to be aware of?
It's definitely not for everybody. There's so many little things that you wouldn't think of. The big one is property management. And that continues to be a big challenge. A traditional multifamily property manager, and we all know them. I mean, some are good, some are not that great. It kind of depends on the regional you're going to get, right? You get a good regional, your asset's going to kick ass. You get a bad regional, your asset's going to tank, right? But asking them to do something that's outside of their comfort zone, outside of their process, a lot simply won't do it. They'll say, because the short-term guests are very, very picky, and you live or die by those reviews, right? On a long-term multifamily, when I have a 200-unit multifamily, I don't really care what Google review says, because you can pick any of these multifamilies and they all have bad Google reviews, right? They all suck. You could mismanage your 200-unit and still have a 2x multiple on the back end, right? There's so many ways to screw it up and still win. If you're good at remodeling, if you can make it look good on the outside, if you can raise rents on 10% of the units, right? You'll make a lot of money. And if you buy right, the 3 things that deal junkies need to be good at, you got to buy right, you got to remodel right, and you got to know your underwriting, right? If you could do those 3, but you can't operate for shit, you don't have a good property manager, you'll still make money. But in the short-term game, it's all about operations, right? You can find deals, but if you can't operate it, right, you're not going to make money. If you stack up bad reviews, nobody's going to go there. So the operations are the biggest challenge, where for multifamily, there's still a challenge, but they're a lot easier to work your way through it. And you have a longer timeline. You can work your way. You can stumble through it over a year, get it right. It could take you 1.5 years, 2 years to get it right. But once you do, you've created that exit, you've created that value, right? Whereas in short term, you always got to have it right. You can never take your foot off the wheel, but the reward is cash flow. The reward is cash flow, right? And exit, because if you've given the next guy if you've shown him how it can be a multifamily, you've now created a multifamily exit, which is 2x the hotel exit today.
Well, now what you're doing is you're starting with an even lower basis than anyone can even touch, right? So you're way ahead on that side. So yeah, there is, their operations have to work, but at a certain point, I imagine that kind of changes over, where it's like, well, so you have that kind of changeover. At what point does that changeover kind of happen where you're like, all right, now we're kind of like fully multifamily? Because you're kind of bridging it, right? Like you're starting with the Airbnb, that's a bridge into the full multifamily. You don't want to lose the cash flow. At what point does that change over? And then at what point do you look at exiting this thing?
Those are all great questions. So regarding the exit, I'm about to find out. I have that first one is now listed, right? And we've had some action. It is a 3.25 multiple from what I bought it for a year and a half ago. Brokers telling me we're getting a lot of action and we should get it. Okay. As far as the bridge, the way I did that one isn't how I'm doing them now. The way I did that one is I gave the whole building to the property manager. I managed the remodel. I made it look pretty. I gave it to the property manager. And after 3 months, they were about 40% occupied. I said, that's it. I'm not letting these units sit. We're going into peak season. And that's when I kind of bridged it. So everybody's going to have his own kind of strategy. A lot of it, Garrett, is going to depend on the type of asset and the unit mix you have, right? So if you have a unit mix the 168 unit I purchased in Phoenix over a year ago, or about a year ago now, those were true, 1 bedroom and 2 bedrooms already, right? They were already set up in that style. They had full kitchens. So those are a little bit easier to lease. But then again, they have that much more value as short term. So it's always hard to strike that balance. It depends if you're a cash flow investor or you're in it for the exit, right? Personally, I'm in it for both, right? So I want to maximize the cash flow while I hold it, knowing that it's going to constrain my exit, right? So what's going to happen with Phoenix, for example, my exit's definitely going to be a multifamily buyer, right? But he's going to have to finish the conversion himself because I'm never going to have more than 50% that are long-term leases, right? The good news is in today's market, I'm not going to take that much of a haircut on valuation because I've done the permitting, right? I got the multifamily property manager in place, and I already got half of it that have long-term 6-month leases in place. The issue is they're probably not going to be able to go straight into GSA debt, right? They're probably going to have to do bridge, right? So they're going to have to underwrite it maybe $500,000 less than they would otherwise. But I'm going to get the cash flow during that time, and maybe they won't have to underwrite it less because it's Phoenix. It's a decent location. It's close to so it's a balance, and I don't know the answer until I've exited a couple of these. Right. So we'll find out. I could either be the smartest guy in the room or the dumbest guy in the room doing all this work, because let's be clear, the majority of my portfolio, 1,000 units plus, is multifamily. I'm not a hotel guy, right? I'm just dabbling in this because I'm trying to play to my competitive advantage, right? I don't want to compete with Nighthawk Equity, right? That's got investors, got a stack of investors, and you see a deal you like, you can go. I don't want to compete with you. Right? I can't compete with you. I can't do that many deals that you can do. And there's a lot of guys in Phoenix like that, right? Established players. So I'm not going to go into Phoenix and compete highest and best on 30 offers, right? For a Class B asset that needs all 200 units remodeled. And I got to do all this heavy lifting. I got to buy it at an in-place 4 cap, spend $2.5 million in CapEx to then bring it to a 5 cap and then have the next guy buy it at a 4 cap. I don't want all those risks. That's not my competitive advantage. I'm not going to get a good deal in that market today. Okay. Unless it's in a market that people aren't looking at. But in this hotel market, right, I can get quality choice assets, right? I'm buying one in Tempe, one in Chandler. These are markets that are A++, in our market, right? That I couldn't touch as a multifamily guy. You're spending $250K per door. But here I am buying 2,000 plus assets, 90 a door, right? With no competition, because what's the syndicator doesn't want that? How are you going to underwrite that? He doesn't know how to underwrite that. How are you going to convince your investors about that, right? How are you going to get debt on that, right? He wants nothing to do with that. It's too much work, right? So I'll come in. I have built the hotel relationships with the brokers now. They're all coming to me, wanting deals. And what I've learned is all of these assets are held by the same profile of investor. And so I know how to speak their language now. And so the deals are plentiful, no problem with deal flow in this segment.
Yeah, I love that. And plus, if I heard you correctly, you're getting a 3x multiple of what you paid a couple of years ago, if I heard you correctly. So the increase is pretty substantial. What I love repositioning existing assets to some other use, or converting an existing multifamily in Airbnb. There's a guy that uses that as a strategy, right? Or if you figure out other ways, other different profit centers, like putting up a cell tower or a billboard or trash valet, you're buying fair market value. You seem to be overpaying, but you got something up your sleeve that no one knows about, right? It's like you're like, why is Serge paying so much for this hotel? Like, what an idiot. Meanwhile, you got something up your sleeve, right? You're repositioning the asset. Now, let me ask you, could you be able to do that without turning it into an Airbnb? I mean, if you had a property manager who could lease up, 15, 20 units per month, if they could do that, right? Within a year, they could have 100, they could have 60, 70, 80% leased up. Now you're juicing it, right? You're accelerating it, but not everybody's going to be capable of doing that. Do you think your strategy would still work if you didn't do the Airbnb?
It would. It definitely would. And it may be a better strategy, right? Because you're making your nut on the exit, right? And that's the exit that they want. So I'm very conflicted in this regard. This next batch of assets that we're purchasing, I'm conflicted on how to roll with it. So definitely that's in consideration. But once you do it the short-term route and you see the cash flow is 3x what it is as a multifamily, like 3x. Like my 168 unit in Phoenix in the month of March did 450,000 top line, right? So to put that in perspective, 450,000. I mean, it's not going to do that every single year, but so as a hybrid, right, it's going to do approximately $3.8 million top line, and it's going to do 1.6 to 1.7 NOI, right? Which in Phoenix today, for even 1.5 million NOI, you're paying $34 million. Right? $32 to $35 million, right? This is an asset I bought for $15 million. And it's an asset that underwrites as a multifamily to 1.25 to 1.4, right? So 1.25 to 1.4 as a strict multifamily, so it's going to exit at 28, 27. And my proposition is it's going to exit at that regardless of how I run it, because I've taken all the hair off the property. I've taken all the risk, right? So it comes back to real estate, right? You buy something with hair on it, take the hair off and sell it nice and shiny, right?
Yeah,
and that's all I'm doing.
And what you did, I mean, because like you said, you went through the entitlement process, you already converted. It's a multifamily. What happens on the inside? I mean, listen, you can maximize your exit if you make it as close to a normal multifamily as possible. And so I think you're kind of struggling with, all right, how do I actually do that and keep the cash coming in, but tee it up for the next guy to buy it with, their lender, they come in. So closer you can get to it being a conventional multifamily. Of course, that's going to reflect in your exit price ultimately. But at the end of the day, I mean, you're sitting fat and happy with a ton of cash that's coming in on the asset. You get to sit back, enjoy that. You work towards it. And then, when it's time, you'll see where you're at in the process. And hey, maybe even if you exit and you don't maximize that all the way, leave something on it for the next guy, which is pretty awesome. And so
there's other considerations though, right? So when you buy it, you don't have the entitlement, right? So I'm not able to get these deals by going in and saying, I need 9 months to get my entitlements before I can buy. Nobody's going to give you a deal doing that, right? Those days are over. So you got to come in, you got to have your legal team give you an assessment, right? Within a week, basically, of the probability, you're not going to know 100% before you close whether you can even do it. Some cities won't let you do it. They want the tax revenue, right? So you can't, Michael, back to your question of why not just go full multifamily, you may run into some density issues, right? Bringing in long-term leases right away before you're entitled. So you have to be prepared to run it as a short term in most cases, especially in markets like Tempe or certain cities that aren't that easy to do this. So again, this is more hair on the deal, right? You got to be able to run it as a short term in the short term, right? You got to be able to underwrite your hold, which is very, very variable. And then you got the question marks. What do I do with the furniture? How do I remodel it? You know, so it's not a traditional multifamily play, right? Which kind of gives you the market to yourself, right?
Yes, it's so cool. So cool. Serge, I love it, man. This has been so fantastic. How can people find out more about you?
I'm on Bigger Pockets. You can find me there. LinkedIn, you know, I'm not hard to find.
Just hunt me down.
Yeah.
Okay.
I found you, awesome. Garrett. You, Garrett. I heard you on a podcast. You had great ideas on remodeling, right? On your value adds. I'm like, I got to talk to this guy because I'm in the middle of value add hell on all these complexes. I don't know what to do about this problem, that problem, all these problems. And I found you.
Yeah. Listen, good people find each other. Serge, we've been talking for a minute ever since, and we kind of hit it off, and we're both local, but man, you've got such a fantastic story, and it's been a pleasure to be able to have you on this podcast. Right away after I talked to you, I'm like, we got to have him on because you just bring so much value, and this has been such a fun discussion. So thanks so much for being here, my man. And look forward to chatting again.